Let us look at how inflation impacts stock market performance. How does inflation affect stock market performance? So inflation, that is the rise in the general level of price, prices over time, has a significant impact on the on stock markets performance. The relationship between inflation and the stock market is somewhat complex. It's complicated with effects, varying, based on the level, duration, and as well as the expectation of the inflation. So here are how inflation reduces or uh, influences the stock market. Number one is impact on corporate profits. What is the influence of inflation on corporate profits? Impact on corporate profits. In a situation where there's a rising cost or higher inflation. And higher inflation increases, input cost. That's the cost of raw materials, cost of wages, and the overall cost of running a company, which can erode corporate profits margins if companies cannot pass these costs to the final consumer. This often leads to lower stock prices. Then it equally, affect pricing power of consumers. So companies with strong pricing powers, like utilities, like consumer staples, can maintain profitability during high inflation, which may support their stock prices because of the essential nature of their goods and services. People still buy regardless of the level of inflation in the economy. Number three is interest rate and inflation. Interest rates and inflation. Central banks such as the Federal Reserve, in the U.S. and in all other countries, often raise interest rates to combat inflation. They tinker with interest rates to see how they can mitigate the impact of inflation. And so higher rates, increases borrowing costs, reducing consumer spending, and corporate investments, which can negatively impact, stock prices. If the corporation invests less, they will tend to have a lesser turnover and a lesser profit. But if they invest the more, all things being equal, they have an increased profitability because of the increased turnover. So rising interest rates also makes bonds more attractive relative to stocks, leading to capital outflow from the equities markets to fixed income, sector, fixed income investment like bonds. Number three is sectoral impacts. Sectoral impacts here. So you consider the winners in this aspect. So the winners are the energy and commodity sector, energy and commodities. So companies in these sectors benefit from higher price for their product and for their products, during inflation. But for real estates, actually, it's equally a winner. Real estate, stock often performs well as property values and rental income typically rise with inflation. Usually, whenever there's inflation, it's over that landlords will increase their rents. They will increase their rents so as to be able to, support their buying power. So, who are the losers here? Number one is technology and growth stocks. Technology and growth stocks. The winners are energy and commodities, and as well as real estates, whereas the losers here are technology and growth stocks. So these sectors are negatively impacted by rising interest rates as their valuations rely heavily on future earnings, which get discounted more during inflationary pressure or periods. So whenever there's high inflation, consumers tend to, investors tend to discount their future earnings. They bring it lower than what they initially expected. You know. So number four is consumer spending and demand. Consumer spending and demand. So in this case, inflation reduces consumer purchasing power. People's ability to buy, to purchase items will reduce, potentially lowering demands for discretionary goods and services. This can hurt sectors like retail, like travel, like leisure, to declining stock prices in these areas. So companies in these particular areas will suffer as a result of inflation. People will no longer buy things again, like the retail sector. They will not travel, like in the leisure sector, because of the level of inflation. Number five is market sentiments and uncertainty. Market sentiments and uncertainty. Discover that persistent inflation creates uncertainty, leading to increased market volatility. So investors may become cautious, leading to a sell-off or shift to defensive sectors. And so inflation expectation, plays a critical role. If investors believe inflation is temporary, the market impact will be minimal. However, persistent inflation can trigger, long-term bearish, sentiment in the markets. Number seven is number six rather is real versus nominal returns. Real versus nominal returns. We need to consider this. And so inflation erodes the real value of investment returns. Generally, when you get your returns, those returns are impacted by inflation. Definitely. So even if stock prices rise during inflations, the real purchasing power of those returns may decrease, reducing the attractiveness of equities. It will reduce. And you discover that it will certainly reduce the it will reduce the attractiveness of equities. So number seven is historical perspective. Historical perspective. So historically, moderate inflation that's around 2 to 3% has been favorable for stocks as it indicates a growing economy. However, higher inflation above 5% often leads to poor stock market performance due to economic instability and rising interest rates. So these figures are very important because they go a long way in affecting the stock prices one way or the other. So in conclusion, inflation significantly influences stock markets. It influences the performance of stock markets actually, and it's something we can't afford to ignore. It affects companies' profits. It affects interest rates. It affects consumer spending. And even investor sentiments are affected by inflation. And so while certain sectors like can benefit from prolonged high inflation, some other sectors may not really benefit. It will affect some sectors. So investors need to monitor inflations and adjust their portfolio to mitigate the risk and then capitalize on inflation resistance opportunities.